All right, well, I want to go ahead and welcome everybody. Thanks for joining. My name is Peter Wardo at the Santa Cruz Valley Chamber of Commerce. I appreciate you. I want to thank John Vance and his team as well for also putting together this webinar. So John, thanks. Before we get started, I just want to go over a couple housekeeping items. Number one, as always, just make sure to check our events page, www.scbchamber.com. And then hover over the events tab and click upcoming events, make sure to register. The other thing, I know Zoom is no platform for anyone, but I do just want to make one thing clear on the webinar side of it in case you haven't used it. At the end of John's presentation, we obviously will go into Q&A. You do have the option to speak if you'd like. At the bottom, you'll see a raise hand feature. Go ahead and click raise hand. I will unmute you. And then you can speak. If you don't have speaking capabilities, obviously feel free to use the chat feature and we can go ahead and read the question out for you. So with that, I just want to quickly introduce John in the webinar and then we'll go ahead and get started.
Hey, Peter.
Yeah.
One of our attendees put in the chat that it's a little hard to hear you. That your sound's kind of coming in and out.
You guys able to hear me now?
I think it's a little bit better.
We'll try it this way. So again, I'll go ahead and just do a quick bio on John, and then we'll go ahead and get started. So John has firmly established himself as a thoughtful leader in the financial service industry. Whether educating clients, professionals, or members of the community, he's demonstrated a commitment to staying ahead of the rapidly changing financial markets and economic climate. He has extensive experience working with individuals and families, listening and addressing their financial concerns, and establishing trust through genuine, caring, and sound financial stewardship. John opened Vance Wealth in 2003 as a financial service practice with a client-centric culture dedicated to caring for clients and their families. So as you know, for today's webinar, John will discuss how to maximize tax deductions as a small business owner. He's going to review payroll optimizations, retirement strategies, and tax efficiencies. So with that, John, I'll go ahead and turn it over to you.
All right. Thanks, Peter. Well, hopefully everyone can hear me well. So we, as a firm, one of the things that we've been doing more and more of is really focusing on tax planning, really partnering and collaborating with tax professionals, so your CPA, enrolled agents, and really helping clients get a better experience from a tax planning perspective. And so what we're going to focus on today is we're going to kind of start at a high level, and then we're going to work our way in towards some of the weeds. And so, one of the things, just a really important caveat as I'll pull up here my disclosure page. One of the things that's really important to know from a tax and legal disclosure is that this should not be considered tax or legal advice. It's really important that you consult a tax consultant or legal counsel on some of these issues that we're going to discuss. So I think that hopefully what you'll get out of this is some really good ideas that you might be able to utilize for your business and personally. But as you take notes, these are definitely things you want to be having dialogue with your tax professional, because that's who you collaborate with. That's who signs off and makes sure that any of these strategies are useful for you. And that's also one of the hard things as we go into and really talk about advice, is that tax advice is very specific to the individual. So what I want to first do is really talk about what types of business owners can most effectively utilize this advice. And so I did it here in a little bit of what I would call an order of effectiveness. And so we start thinking about a business owner, single owner S corporation with no additional employees other than family, right? So it's just a one-person shop. This is the group that can really take advantage of some of this tax consulting or tax planning that we're going to discuss today. Number two is a single owner S corp with 2 to 20 employees, which is probably a big chunk of what our chamber membership looks like. The third category is sole proprietors or independent contractors or LLCs with no employees. And potentially this group needs to look at, does it make sense to establish an S corporation? Or if an LLC file is an S corp, and that would be something you would want to pursue with your accountant. And then S corporation with 2 owners, and lastly, single owner S corporations with more than 20 employees. So this really applies to everyone, but it's interesting. The smaller you are, the more flexibility you have with being able to utilize some of this advice. And the other side that you can see in the blue box is really applies. You can get the most bang for your buck with tax deductions, and the 24% federal bracket or higher. And that really is looking at a single filer at above 86,000 taxable income, and a married filing jointly at above 172,000 of taxable income, not business income, taxable personal income. So I do like to start a little bit. I like to start big picture around this tax planning philosophy that, you know, I'm a certified financial planner. So our job is really to help our clients understand all aspects of their financial life, from their cash flow to their insurance, to their investments, to their retirement planning, estate planning, and obviously tax planning. And from a philosophical perspective, you know, one of the things that I see too often is this approach to essentially try to pay no taxes. And I'm going to try to hopefully convince you that that's not the best strategy. And so here's some of the key ideas we're going to go through today. We do want to minimize our tax liability. But when we talk about the key ideas, number one, pay yourself a market-based wage. Too often than not, business owners are not paying themselves a market-based wage. They're either paying themselves too low, not paying themselves at all. It's really important to pay yourself a market-based wage. It's also important in the eyes of the IRS. If you ask your accountant about that, they will certainly give you guidance on that. The next one, number two, focus on being profitable. Don't just spend money to avoid taxes. We see too often people are super excited to get these deductions by spending money, but it's at the expense of their own profitability. And you see the bullet point: paying taxes is the goal. It means you are making money, which is why you have a business. That's why we all started a business. I'm a business owner myself, and that is the goal. Pay taxes. You're doing well if you're paying taxes. Number three, be careful about accelerating deductions using Section 179. So the IRS does allow for some parts of the tax code where you can accelerate deductions. And I think oftentimes people are so adverse to paying taxes that they utilize this, but sometimes, and in a lot of cases, it's not in their best interest. If you are in the 24% bracket or lower, it might be best to pay the taxes now. And when I say it might be best, you know, every business is different. So it's hard to be uniform in that advice. And it's really important, ask your accountant and or tax professional about the specific deductions because there are many and it gets more complicated. We're not going to go into that today. We're really going to get into some of these more creative tax planning items that business owners are not really aware of and can really make a big impact, not only on their tax savings, but also on their long-term financial goals. And so we're going to try to pair those up today to really dig deep. So one of the things that I first want to review is current tax rates. And if you notice on the headline of this, it says 2021 versus 2017. Now, I realize that we are on the verge of a new tax proposal that's going to come out of the Biden administration, as well as, you know, get voted on by the House and Senate. But as of now, this is how it stands. And the reason why I have listed on here the 2017 tax rates is because if you notice the footnote at the bottom, when the Tax Cut and Jobs Act of 2017 was put in place, these tax rates were set. They're going to go up based on inflation, but they're set to expire at the end of 2025. So without new legislation, which we're going to see some, so this might replace some of this, 2026 tax rates will revert back to the 2017 tax brackets. So the reason I highlighted this middle group is that if you look at, on the left-hand side, it's a single filer, and on the right-hand side is a married filer. So to not get into the weeds too much, I'm going to focus on the right-hand side, married filing jointly. Obviously, if you're single, you can kind of follow along on the left side. But the reason why I highlighted this middle section is if you look at the old tax brackets, there was a 25% bracket, a 28% bracket, and a 33% bracket. So the whole idea is that if tax rates revert back, in most cases, business owners are going to be paying higher taxes in the future. And so the reality is we might have a temporary gift here of this 22 and 24% bracket. And if you look at the 22 and 24% bracket, you know, that represents income from 81,000 up to, and you can see the bright green, almost $30,000 of income. So up to $330,000 of taxable income, you're going to be paying at rates below the 25, 28, and 33. So the advice around this is that, do you want to take a deduction today, Or do you want to maybe delay some deductions when you purchase equipment or things like that? Because in the future, you might have some of these higher rates. And so I would definitely take a hard look at that. We kind of feel like it's a gift if you're starting a business and you're in some of these lower rates like 10 and 12 and 22, it's okay to pay taxes. Focus on profitability. So hopefully that makes a little sense, because I think we're all hardwired to save money today at all costs. How can I save? How can I pay the lowest amount of taxes? And I would challenge you to take a different approach where you are not only looking at today, but you're forecasting out and saying, okay, well, how do I pay less over my lifetime, over the next 5, 10, 15, 20 years? And by utilizing the way the tax codes are structured today can help you plan for that. And the problem is we don't have a crystal ball, so we don't know what the future is going to be hold. One of the things that it seems like is going to be intact, because part of the Biden administration proposal is that taxes are going to go up on single filers above 400,000 and married filing jointly above 450. So I have a sense that these lower brackets are not going to be touched. But as it stands now, they haven't dealt with the sunsetting provision. So it still seems like the sunset provision, meaning they're going to revert back in 2026, is still intact. And so I think you really have a unique opportunity over the next 5 years to make some good decisions around your financial situation as well as taxes. So hopefully that makes sense from a big picture. Okay, so what we're going to go into is talk about business and tax planning, and really starting with the focus on business planning. So I guess one of the areas I think we're all frustrated as business owners is there's just not enough time to really work on the business, right? Spending time, setting your goals, making sure that, your financials are healthy, really tending to the business. And, that's in the category that we talk about around important, but not urgent, right? The things that we know are important, but because they're not urgent, they just sit on the back burner. And this is the whole idea around how do you focus and spend more time working on the business so that your business can thrive and can prosper. So one of the things that we recommend, and this is part of Vance Wealth as well as our Simplify 365 team, is to schedule monthly planning meetings. And this would be, like I said, focus on goals, focus on things that are important to the business. And as a business owner, I recommend away from the office without distractions, because I know when I get in, I'm bombarded with my team, which is great. That's why I'm here, but also with emails, constant distractions. So get out of the office, because we know as business owners, especially if you're small, I remember this when I first started, with no employees or maybe 1 or 2, you have a lot of administrative issues you have to handle. You have to deal with bookkeepers and accountants and attorneys. You have all of these needs, right? There's a lot of administrative stuff. And, sometimes you can outsource that, but this can also be costly because you got to hire all these outside professionals. And depending on where you are in your business, it can become costly and timely. And so by scheduling this monthly planning meeting, it allows you to get away from the noise and really work on your business. So just some sample related issues. If you are an S corporation, you have certain obligations that you have to follow. You don't want to pierce the corporate veil. So there's things you have to do as part of your obligation if you are an S corp. So you have to create and regularly update your bylaws. You got to hold annual meetings. You have to undertake certain filing requirements required by the state. You have to document major business decisions and meetings held. And one of the key things too, and this can get a little tricky for small businesses or businesses with no employees, is avoiding commingling business and personal assets. That's really important. So this is just a list of a few, and we'll also make this presentation available if you want to see the hard copy. So how do we actually execute on this? And so now we've kind of taken a page out of the Bill Gates's Think Week, where you spend time away from the office, and we just call it like a monthly planning think day. So how do you do this? So again, our recommendation is take a full day uninterrupted without distractions away from the office. And so how do you accomplish this? We would look at renting a nearby conference room, potentially, a room at the country club, something, a room at the hotel, somewhere where you can get away from the distractions. Or what you can also do, because you probably have less distractions at your home, you can rent out your primary residence to your business. So you take that approach of like, hey, I'm just going to be utilizing my house to accomplish this. So if you rent out your primary residence to your business, you might be able to use inside the tax code, IRC section 280AG, which is also known as the Augusta rule, which allows you to rent out your business, your house to your business tax-free. So let's talk about how to implement this. And so one of the things that's really important is you got to have a dialogue with your accountant about how this would apply to you and if it makes sense. So how to implement this for your business. And so basically this part of the tax code gives you the option to legally rent out your home for up to 14 days per year. You cannot exceed that, up to 14 days per year without having to report the rental income on their individual tax return. And technically you do report it, but it's non-taxable. So if you're renting your home for 14 days, let's say a $2,000 per day rental, $28,000 would be deducted from your corporate tax return, lowering business net income by $28,000. If you're in the highest tax bracket in California, that could save you nearly $14,000 a year just in taxes. So your business is allowed to deduct this because this is you're renting from your business, which is a separate entity. And so it's essentially like taking a tax-free distribution from the company. Now, a lot of you might be thinking, well, how have I not heard of this? It's because it's just little known. It's little used, primarily because as a business owner, there's not a business purpose. And so you see my notes at the bottom. The risk for you as a business owner in taking this deduction is not having a business purpose to rent your personal residence to the business, right? You can't just charge rent if there's no activity, right? So, and also the important thing is if you don't have documentation to support the business purpose, right? So it's clearly important that if you're going to do this, if you're truly going to work on your business, taking this monthly planning day, which would give you 12 days in a year, is you have to document the business purpose, what you're doing, and the need for not being in the office. So let's talk about how to implement this. So one of the things that you do is, determine how your business is going to use this. So the most common that we see is you have a monthly meeting, which gives you 12 days. You have an annual officer/minutes meeting. Now, that's something that's required. That's 1 day. And then you do like a staff appreciation day. So if you have a team, we did this, we had a barbecue at the house. And so we did 1 day where people came over and enjoyed the backyard. And so that's a staff appreciation day, again, at your house. Build the schedule according to your needs. One of the key things is you got to make sure you're not using the house for clients, for entertainment, or personal reasons. This truly has to be to business and for your team. But make sure you talk to your tax professional about all the limitations. It's really important. Then it's also, as you start going through these steps, so determine how you're going to use it. Number 2 is reserve the 14 days. Put it on your calendar, document it. Number 3, make an agenda and take minutes. It's really important that you have documentation of what was covered. Otherwise, it just feels like you're trying to not pay taxes versus having a legitimate business purpose for the rental of the house. Step number 4, get comparables. Look around and find out, well, what would a hotel charge me? What would a country club charge me? What are the things that we could look at to actually justify the number, whether it's $1,000 a day, $2,000 a day, $3,000 a day, whatever that may be. Also, we have the benefit of being in Los Angeles area, and this applies nationally, but where you could look at, what are some of the filming rates, right? If you're going to rent your house out to a studio, what would you actually get reimbursed? So try to find a comparable number, and then, use something that's reasonable based on the size of your house and the size of your business. Number 5, have a rental agreement in place. Remember, this is an agreement between you, the homeowner, and your business. So get a rental agreement in place, and then you got to invoice. This is a legitimate expense. You have to invoice the business. And you can't pay 14 days at one time, especially at the end of the year. That's definitely a red flag. And then as a business, you're going to need to issue a 1099 to the homeowner because this is a business expense that you're paying to an individual, not a corporate entity. So, there's compliance that's required on this, and then the income gets claimed on your individual taxes. But your accountant needs to do this appropriately. It'll be coded as non-taxable. So there's a lot of steps. I know it's like drinking through a fire hose, but I'll be available afterwards if you want to have a consult on how this might impact you. But those are really the main steps on how to implement this. And so part of the documentation that we help with, and this is easy for you to do, but just have a sample monthly planning agenda. What are you doing? What's a meeting summary? Are there personal and business updates? Biggest challenges, productivity suggestions. What are the things you can do to run a better business? Focusing on your goals. Are there questions for us? There's questions for your advisor. What are the action steps? So it's important to have an agenda, take notes, because you want to have documentation about how you spent that time. Some of the things we also really like to look at is what are some of the business compliances and best practice deadlines? What are the things you should be doing in January? Looking at deadlines, you can see at the bottom here, like 1099 deadline to issue as a company is January 31st. So what are the things throughout the year that sometimes we forget as business owners that we know we just need to kind of check off? We want to update our business plan. There's just things that have to happen on an ongoing basis. And this monthly planning day is a great way to kind of take care of all this at one time. And we all know this kind of idea of time blocking, right? Where you're dedicating focused time, and that focused times allows you to get a lot more done because you can dedicate 6 hours, 8 hours to it and not have distractions where you're constantly getting interrupted and not being able to spend time. So that's a unique strategy known as the Augusta rule. We're now going to pivot into some other areas around payroll optimization and retirement plan strategies. So again, I know I'm going fast, but I wanted to make sure I get to the meat of this, and I'm excited for some Q&A. So payroll optimization. So this is basically the perspective of how can I maximize compensation for you as a small business owner and your family? What can we do? Are there strategies in place that we can utilize? And so payroll optimization, who can benefit? Well, adding a spouse. As we all know, spouses are sometimes working full-time in your business, or they're just helping out as needed. And so clearly there has to be, you can add your spouse to payroll as long as they're doing work and they have a job description. And one of the reasons why you would do that is you can increase retirement plan contributions by, in most cases, over $55,000 a year. And that accomplishes two things. It puts more money away for your retirement, but it also helps to save some taxes. Adding your children to payroll, that are in junior high, high school, and college. And, one of the things that we know, because we work with a lot of higher net worth business owners, is that the value to children is the benefits of working at a young age, the benefits of understanding the family business. And so, but you have to be reasonable with this. You have to pay them a reasonable wage based on the work that they do, documenting things like time cards and job descriptions, right? So you have to go through the process of, if you're going to utilize this as some tax savings, is making sure that you're doing things that are above board and that you're documenting it. And really the benefit for taxes is you get larger tax deductions for your business and personal tax return. Then we look at retirement plan strategies. So this is really ensuring that your retirement plan is utilizing all available tactics to optimize tax and saving strategies. So that's the simple goal. What's the goal of your financial plan? Is it to save taxes? Is it to maximize retirement savings? What are the things that I really want to look at? And that's what this section is going to go through. And one of the things that I'll pivot here in a second, but so retirement plan strategies, who can benefit? So for you and your spouse, adding your spouse to payroll allows them to maximum fund a profit sharing plan, which allows you to get more money. You can also consider a Roth 401k. Many business owners are not eligible for a Roth IRA, but they are eligible for a Roth 401k. There's no income restrictions. So it allows them to have an account that builds tax-free. And I know tax-free is one of the areas we always like to hear as a business owner, but most business owners are not taking advantage of the Roth option. And then for your children, by adding them on payroll, the ability to pay some of your college expenses, funding a 529, also the ability to fund Roth IRA accounts early. So, and early in life, because we know the benefits of compounding. So this is what we're going to go through. So we're going to pivot now into some specifics around these strategies. And I apologize ahead of time because there's a lot of data on here, and I'm going to try to slow down a little bit as we go through this. But we're going to go through some examples. And so what we're looking at here is a hypothetical. So I'm going to walk you through kind of the initial scenario, and then the stories are going to kind of build on themselves. We've had to make a lot of hypothetical assumptions in here. So I just want to let you know that this is hypothetical. It's highly accurate. I can't tell you it's perfect, but it's very close to that because we're using spreadsheets and not some of the tax software. Just trust me, generally we're in the right vicinity, but it's mainly to get the concept of, what are some of the things you can do. So this is what I would call the traditional way of funding a retirement plan, where it's just the owner, spouse and children are not involved. And you can see in this scenario, we have the primary owner is 50 years old. This is a business that's doing quite well. The owner is taking W-2 income of $350,000. Business net income prior to the payroll is about $1 million. So they're doing quite well. And one of the things that I will tell you is this applies to you in a scenario where your profits are 200,000 or 300,000. So this is not just for the larger, it really does encompass it. Now, we do know how the tax code is built. The higher the bracket you're in, the more bang you get for your buck, right? The more value you get in some of these strategies. If you're in lower brackets, some of these strategies might not apply. So if you notice what I've highlighted here in red is the ability of this owner to put pre-tax contributions, which means they get a tax deduction of $64,500. That money gets to be saved into their retirement plan, and their net savings because of that contributions is around just over 31,000. And this is going to change based on California tax rates and federal, but this is the current saving. So this is why people like using 401ks, profit sharings, especially when it's just the owner, there's no employees, because you can save on a pretty hefty retirement plan contribution, almost 50%. So then we look at the next kind of phase. Well, what if I add my spouse to payroll? She's working for the company, and he or she's working in this scenario. Actually, I have it reversed, but you can see because in this scenario, we're looking at Angela. She's the single owner, right? So her husband does work for the business, is getting added to payroll. And so if you notice the W-2 income, her W-2 income dropped to 285,000, and the W-2 income for her husband is at 65,000. So all the data is essentially the same, but by adding the spouse to payroll, now the total pre-tax contributions for this plan is $129,000, which basically what I highlighted in blue and in yellow at the bottom means that by doing so, this couple can save an additional $25,000 in taxes. And so that's pretty powerful, right? By just doing that, you're going to save not only for retirement, but also for in taxes, which is obviously many of our goals. So the one thing that I do want to add into here is, and you can see in the headline, how much can I save, but adding the Roth 401k. So this is something that too often than not, business owners are not looking at. And so what I actually looked at here was, okay, we're going to assume that the contributions are going into the Roth, 100% of it. And you can see what I highlighted in red. The pre-tax contributions are at 77,000 for husband and wife. And the Roth contributions are at 52,000, which is the max that they can do. And then I highlighted at the bottom, well, what is the additional tax savings? And so look at that number. It's basically negative $76. So that means in this scenario, there is no tax savings by adding the Roth. But I'm going to illustrate later why that matters. Because remember, a Roth 401k is not a deduction. You cannot, it's not a tax deduction. So in this scenario, by adding the spouse, but by being able to put away $52,000 per year into a Roth account, there is no additional tax savings to that dynamic. It's the same from a tax perspective, but it's different because now you're putting money into a Roth. So hopefully that illustrates the point around how to utilize a Roth in terms of looking at payroll and retirement plan optimization. So this last one gets a little bit more complicated. I highlighted here, I probably should have made that circle a little bit bigger, but I just kind of said child one and child two, right? Really just looking at a scenario. Now you can run this for one child, for four children in a family. And this is just looking at a scenario where you pay a little bit over $1,000 a month to each child for the work that they're doing in the business. And kind of the summary of it all, as you can see, basically inside the box in the bottom right corner, by adding the children onto payroll and paying that amount, that we're going to have a net savings of around $10,000. And so putting around $26,000 away does, you do incur some additional costs like payroll costs. You do have some additional taxes. But in this situation at a higher income individual or higher income family, it'll save about $10,000 per year in taxes. This also opens the opportunity up. You can see in the boxes on the right-hand side, outside of the box, it says Roth contribution and 529 contribution. The whole idea, with having the kids work for the business is that, you want to utilize these things to set themselves up for the future. So you have the ability to put this cash flow away in Roth IRAs and or college accounts, depending on the situation. So now we're going to dig into some of the benefits of like the growing of the wealth, right? We focused on some of the tax savings and some of the ability to put money away. So one of the things that I want to illustrate here is, what if you could fund this Roth and put $52,000 away? And the reason why we're bringing this up is we know tax rates are going to go up, right? Our deficits are north of $30 trillion. We know tax rates are likely going to go up. So, many people are starting to focus on, well, what can I do tax-free, or what can I do that's not going to exacerbate my tax liability later in life? And so what I'm illustrating here, and I had to make a lot of assumptions, we're using an 8% expected return. We don't know what the future is going to be, but I had to make some assumptions. So this basically assumed that you saved $52,000 for the next 10 years. And then in the bottom left corner, you can see what the future value is. And so in 20 years, that bucket would be worth 1.6 million. In 25 years, it would be worth 2.4 million. And in 30 years, 3.5 million. So the power of just putting away 10 years worth of max funding the Roth, when you compound that over a period of time, you've now just created these massive tax-free accounts, these Roth accounts for later in life. And if you take the same approach to a traditional 401k or a pre-tax, you actually can still accumulate the same amount of money. The difference is, if that account grows to 3.5 million, when you take it out at a later time, you have to pay ordinary income tax. And so if you're required to take 100 plus thousand out, that's going to cause a larger tax exposure to you, which is what makes the Roth extremely palatable. So that's number one, really kind of for husband and wife, looking at the ability to save into the Roth and the long-term compound benefit of that. The other thing is, what I would call investing in your children, for your children. So what's the long-term benefit? So let's just, suppose you had a 16-year-old and you're like, okay, this 16-year-old is going to work for me for a couple of years in high school, a couple of years in college, and really we're going to fund this for 6 years. So I highlighted the annual savings. We're just assuming $6,000 a year for 6 years, which is the maximum amount. And then I want to show you the true benefit of compounding. So this supposes they don't add any more money to it. They stop funding it at age 21. But in 20 years from then, it'll be worth 120. And now remember, we've only put in 30,000. And 20 years from now, that would be worth hypothetically at 8%, 130,000. And at, in 52 years, which would get them to, 52 years from then, it would get them to 1.5 million. So think of the impact of being able to start early for your kids and just depositing 30,000 over that 6 year, 36,000 over that 6 year period. The benefit of compounding in a tax free account like a Roth IRA, over the next 20, 30, 40, 50 years has a tremendous impact. And so I definitely see a lot of our clients who are excited to leave a legacy for their kids. They don't want to give it to them now. They don't want to just blow the money. They want to really invest in their future. So the benefits of starting early are pronounced. And hopefully this chart gives you a little bit of that, gives you a little bit of that picture. And you can see on the left-hand side, that would get them to age 67, which right now is typical retirement. For kids that are younger, likely retirement is going to get pushed out. So just to kind of summarize everything, one of the things that, I really recommend, you can see on the left-hand side, got to do a comprehensive review of your personal tax return. Remember, if you're an S corporation, LLC, sole proprietor, all this flows through to your personal tax return. So make sure you're evaluating, running comparisons, really looking, at 1 year and 5 year, reviews of what your taxes might look like. And then this is just a summary of these 3 concepts we went through. So, and a summary of what it is, and then the bottom on here shows the approximate tax savings that you can save annually. So on the Augusta Rule strategy, $5,000 to $15,000 of tax savings, payroll optimization, $5,000 to $20,000 of tax savings, and then retirement plan design, $7,500 to $100,000. So when I talk, and the retirement plan design is not technically tax savings, it's more tax deferral. But depending on your income, especially if you have some higher income years, there are some opportunities to do plans where you can put far more than I even mentioned today, where the tax savings or tax deferred savings can be up to 100,000. And so, these are easy parts of the planning. It's just kind of looking at your overall situation and really thinking and being more purposeful, which is really the key. And kind of shaking up our old philosophy around how we look at taxes is really taking a longer term approach, because that, in my opinion, is going to be the way that it's going to best serve you over your lifetime. Okay, so these are just our core values as a firm, as Vance Wealth. And then last thing, so for those of you on the call, even if you're listening to the recording, if you want to have just a 30-minute complimentary consultation to just kind of check in about how this might impact you, I would encourage that. But if you don't want to, talk to your own advisor, talk to your own tax professional. Get someone to help you on how to implement these. And so you can either just scan the QR code, and if you want to, book an appointment, you can just go onto our website, which is vancewealth.com. And I think we're going to do some questions. So Peter's going to jump in. Hopefully the volume is good, but I know I moved through that really fast. So hopefully that's just going to potentially get us some good questions today.
I'm here. Can you hear me?
I can.
All right, there we go. Thanks for that, John. As John did mention, we'll make the PowerPoint available for everyone. And then as always, these are recorded. So you can go ahead and go back through and review it. John, I'm going to go ahead and say that I think it was very well explained. I actually do not have any questions lined up.
Okay.
So we'll go with that. We'll go with that. It was very well informed. But again, as John did mention, we will have this up. Please feel free to review it. You guys all have, my contact details. If anything does come up and you need to get a hold of John, obviously contact details are here. Please reach out to me. I'll go ahead and connect you. I'm sure John wouldn't mind, speaking to each of you. As you mentioned here, there is a complimentary consultation available for you guys. But with that, John, I do want to thank you as always. As you guys know, we do host the monthly webinars with John and his team, and they're always bringing in different and relevant topics depending on what's going on in the world. So we do have our next one set. I believe I had the date on hand and I just lost it. I think it's on October 21st.
Okay.
We are scheduled for, again, Thursday, 11 a.m. We try to keep them same time so everybody has them as a reoccurring thing in their calendar. But John, thanks again for everything. Thanks for all you do. And with that, I thank everybody for attending, and we look forward to seeing you all soon.
All right. Thanks, Peter.
Thanks, John.